Okay, so we're going to have a look today at a service firm question, and we're going to look at the 2017 question, which is question number 6 on the 2017 exam. It's a 100-mark service firm account question. Um, a service firm account, like a club account, is laid out in the same way. You have all of the information about this company. It's a fitness center. All of the information about the fitness center at the start of the year in the top sentence. Then you're presented with a receipts and payments account, money in on the debit side, money out on the credit side, essentially a bank account. And then you have some adjustments at the end of the year to be taken into account as well. And they're listed 1 to 8 um, on the next page. And you're asked to prepare a statement of reserves at the start of the year, a profit and loss account for a health food shop, profit and loss for the whole fitness center, and a balance sheet. There's also a theory part, which we'll have a look at in a moment. First things first, I tend to do my service firm accounts kind of like my club accounts in that I'm going to do 2 workings initially. I'm going to do the health food shop profit and loss or trading account, like I sometimes do the bar trading account in a club, and then I'll do clients' fees similar to subscriptions in a club account. So let's look at the health food shop, and this is a really significant working because it takes into account quite a number of things, as you can see on the screen there. It's going to take in this in its entirety. So first off, you're going to set up a skeleton trading profit and loss account with our sales, less cost of sales, opening stock, purchases, closing stock, your cost of sales, and your gross profit, and we're going to take away some expenses. To get down to the gross profit is pretty straightforward. You have got your health food shop sales on the debit side of the bank account. That's 85,000 receipts. If you had debtors for the shop, you would have to add on the debtors at the end of the year, subtract at the beginning of the year, but not in this case. Then you have your opening stock given in the top sentence because it's at the start of the year. You have purchases, again, given on the credit money outside for the shop. And you have, and again, if you had creditors for the shop, you would have to factor them in there, minus at the start, add at the end. And then you have your closing stock, which is adjustment number 1. You work out all of that to get your gross profit of 43,200. Now, here is where we need to focus on. I'm going to look at paragraph 6 of the question, where it says, and this is at the end of the year, wages and salaries include 24,000 per annum paid to the secretary who also runs the shop. It's estimated that 60% of this salary, that's 60% of 24, and 300 light and heat, and 850 of insurance, and 400 of the telephone is all attributable to the shop. So therefore, they're telling us that these 4 are shop expenses. You total them to get 15,950, and you take them away to get 27,250 of an income. That is your net profit on the shop, and that's that bit done. However, counting these expenses in here has a knock-on effect, because if we count them here, then we should not count them in the overall wages or the overall light and heat for the whole health center. This is just a health food shop in a corner of the overall health center. We don't want to count these things twice, so therefore we need to remove them. So we're going to do that one by one. The first one is wages. You take the actual number for wages for the whole center, which is 83,000 from the bank account, and you take out the shop now, and then you'll be left with your profit and loss wages with the rest. In fact, there is another small complication with wages. Paragraph number 5 says the payment for laundry includes 2,700 for 3 weeks' wages paid to a replacement fitness instructor. So we need to take out that 2,700 out of. Sorry, we need to take that. I'm going to go over here. We need to take that out of laundry. It's not to do with laundry. We get a new laundry number. And we need to include it into our wages where it should be. It also says that there should be a further 2 weeks' wages due to this person as well. Well, if 2,700 is 3 weeks, well, then you can divide by 3. and multiply by 2, and that will give you this amount of wages due. And that wages due is 1,800. Basically, it's €900 a week is the wages. And you add on an amount due, as well as adding on this laundry figure from here to here. And overall, your profit and loss wages are 73,100. Now, you have an expense due here, which is a liability at the end of the year as well. And that's your expense. That's 73,100, the bolded number. The second one is light and heat. You take your original figure for light and heat, you take out the shop again. And then you've got opening and closing stock of oil, which you have to factor in. Add the opening stock, take away the closing stock. They're both assets at the beginning of the year. Now, I call it an accumulated fund asset. Technically, that's not right because accumulated fund is a club account term, but you know that it's the reserves at the start of the year. It's an asset in the reserves at the start of the year. And that's a current asset at the end of the year. The expense is 6,700. We also have our insurance, and we just take out the shop figure because we don't want to count it twice to get our profit and loss figure for insurance. And we have our telephone of 1,700, and we take out the shop figure because we don't want to count it twice, and you have your telephone bill for the rest of the health center at 1,300. In that one working there, you're ending up with one income and 5 expenses, as well as some assets and liabilities. Quite a lot in that first work. As I said, we're going to do clients' fees. Here's our clients' fees. Pretty straightforward, really. You take your original number. Now, if you have something prepaid at the start of the year, you need to add it on because it is for the year 2016. And if you have something prepaid at the end, you subtract it because it's actually for 2017. And you also add on the amount due at the end of the year, and you get 271,500. Here, there is a little bit with working for. I'm going to show you that in a few minutes, but for the time being, that's our working to. Now, at that point, you say to yourself, okay, I've got those 2 first workings done. Now I'm going to go seeking out the others. So you start in the top sentence and you see, is there anything else due or prepaid? Well, the next thing is cleaning, and that leads you to a cleaning working, and you add an amount prepaid at the start of the year and you take away at the end, and there's your contract cleaning bill. You have some expenses prepaid at the start and the end, accumulated fund asset and current asset. Then you have your investment interest due. Now that leads you to this interesting working where you write down your investment interest received. You've received €3,000. You're not actually told how much the investment is, but you are told that you have an amount due at the start of the year, which you subtract because it was obviously for last year. We don't have anything due at the end of the year. So therefore we can deduce from that that our actual entitlement for this year interest is 2,700. Now down to here, we can then extrapolate that out to see how much the investment is. If 2,700 equals 3%, then the investment must be divide by 3 to get 1%, multiply by 100 to get 100%. It must be €90,000 investment. And this is an asset at the start of the year in the reserves and at the end of the year in the balance sheet. We also have creditors for supplies, which at the start of the year you will subtract, and at the end of the year you will add on, and that gives you your profit and loss figure for supplies. And that is everything dealt with in the top sentence there. Now we'll have a look at some of the paragraphs at the end of the question. And you'll see we've done some of these. In fact, we've covered number 1 now, the stock of heating oil and the stock of the shop. We've covered number 2, cleaning. We've covered number 3. So we're on to paragraph 4, which is our 6th working. And it says the closing figure for the bank does not take into account 2 things: bank charges and a dishonored check received from a member in respect of fees. Here's how much they tell us the bank is. They say that we have 3,300 in the bank on the debit side, but actually we have to take out bank charges of 110, which is going to be a new expense, bank charges, and we have to take out a check, a dishonored check from a member. This is money we thought we had lodged. Actually, the check bounced. So you take out that 950. Your new figure for your bank is now 2,240, which is a current asset. But I want to go back and talk about these two. Bank charges become an expense, but the dishonored check Well, do you see here I've written C working 2? I'm going to bring you back over to here to show you what happens there. You have to take 950 off the amount that we have received, because of course we haven't received that 950 of those clients' fees. And you add 950 on to member or client's fees due, because that person still owes you. You put it back on to being an amount due. It does not actually affect the 271,500, which is still an expense, but it does mean that your income due is larger and your amount received is actually smaller. So now you have an income due of 3,650. That's how to do working 6. Then we continue to look at the paragraphs at the end of the question, and we say now that we have covered number 4, we have covered number 5 with the laundry, we've covered number 6 with the wages and salaries, and we've covered number 7. So we're kind of getting towards now our depreciation workings. Depreciation is always kind of tricky enough in service firm questions, because you have to first off do this. You have 3 years depreciation prior to this year, accumulated depreciation prior to the year 2016. It's easy enough to calculate that. That is the asset multiplied by the rate multiplied by 3 years in each case. Now, those numbers are the depreciation which were on the assets before this year. And therefore, when you do your reserves, your opening reserves, you have to take away that much depreciation to get your book value. Then we're going to do depreciation for this calendar year, and these are going to be expenses, and for the year 2016. Well, this is slightly more complicated because you have to have billings done into the buildings you had at the start of the year, you have for the full 12 months. And then the building which you bought during the year, you only had for 9 months. So you have to work out the two of those independently and then add them together to get 14,250. The equipment is straightforward, it's just another year we didn't buy or sell any equipment. But the furniture is a bit trickier. We did buy and sell furniture. So we had furniture at the start of 40,000. We sold half of that furniture, 20,000, and we bought 12,000. Now it says in the question that there is no depreciation on the year of disposal. So therefore we don't have to depreciate that 20,000 item in 2016. So therefore, conveniently for us, that leaves us with 32,000 by 20%, which is 6,400 for this year. Now, however, the furniture needs another little bit of attention because we have a disposal of furniture, so therefore we must do a disposal account. The furniture that we sold was 20,000. The depreciation on it was 12,000. How did we get that 12? It is half of the 24 up here because we sold half of the furniture. So therefore it is half of the accumulated depreciation. We received 10,000 for it according to the debit side of the bank account. So therefore we made a profit on that transaction of 2,000 euro. And that's going to be an income, a profit. And then finally, just like if we were doing final accounts, we do this little piece here where we add together this is our furniture situation at the start of the year, how much the cost and what the accumulated depreciation was. You take out the old furniture, the cost of which was 20, and the depreciation. You get rid of both of those because they are no longer in our company. And you add on the new depreciation we add on the new furniture, which we bought, and the new depreciation for all furniture, which is this number here, 6,400. And this is the 3 figures, or these are the 3 figures which are going to go into the balance sheet for furniture. A little miniature balance sheet preparation there. And then there's one other tricky working, not from the paragraphs. We've done every paragraph at the end now, but just within the actual bank account on the credit side, there is a bank loan. The bank loan, it says that it costs 63,000 euro to repay that loan, but it doesn't tell you how much the actual loan is. However, it does tell you that that is including 4% interest for a period of 15 months. Now, 4% interest for 15 over 12 months. That's 4% per annum. It's quite important we use that per annum term. That's 4% for a 12-month period. But if we have it for 15 out of the 12 months, then we will have 5% overall. Now, then we can say quite safely here that our bank loan 63,000 is 105% of the overall loan because it is the loan with 5% interest on top. So therefore divide by 105, multiply by 100 to get your 60,000. And then you have got interest of 3,000. And we know that that is 15 months. We need to establish how much of that is for this year and how much of it is for next year. Well, this year's figures, it's going to be 3 years this year. Sorry, 3 months this year, because we repaid it on the first day of April. So it's only January, February, and March for this year. So therefore, you can divide that 15-month figure by 15 to get 1 month, and multiply it by 3 to get this year's 3 months, multiply it by 12 to get last year's amount. And there you're going to have 600 and 2,400. This is an expense this year's, and the last year's interest and the loan itself are both accumulated fund liabilities. They're both owed expenses due at the start of the year. That's the workings done. I think mainly you guys will be able to fill out the question, the answer itself using the marking scheme, but I'm just going to point out a couple of important things therein so you're aware of them. First off, here's our buildings, our equipment and our furniture. Well, those are the three assets, the cost of which were 600, 80, and 40, but we had to take away the 3 years depreciation. There's our hidden investment. Everything else from the top sentence there, straightforward enough. And down here, you have your loan and you have your loan interest due 2,400 directly from that last working I spoke about. Part B of the question is working number 1. You were asked to do the health food shop profit and loss account. So therefore that is your part B answered already, which is convenient for us. Then we have part C, which is the profit and loss account. 4 incomes, and they are shop profit, investment interest, profit from the furniture disposal, and the membership fees. And then a number of expenses, pretty much all of which are from the workings. I don't think there's anything there that we didn't have to adjust in some way. Giving you a net profit of 117,040, and you add on the reserves from part A, and that gives you your profit and loss balance going forward. And then in the balance sheet, we have our combined depreciation here. This is the accumulated depreciation and this year's depreciation added together here and here. And of course the furniture we had already done up here. We had in working 10, we had already prepared that. There's your investments of 90,000, important to spot that. 5 current assets. The new bank number is in there, membership due. 3 current liabilities. And there's our total net assets, and our finance by is actually very simple here. There is no loan, so it's just the capital and the profit and loss balance. There is also a little bit of theory here where they talk about, can Fitbro afford new equipment at a cost of 225? Well, it's important that you say yes or no here, and in this case we're going to say yes, they can afford the new equipment, and they should finance this by selling investments and by raising extra money through the sale of ordinary shares. They're in a healthy financial position, and you can elaborate then because they have only recently paid off a loan, and they've also had a lot of non-recurring expenditure buying assets. They have made a profit, and they're breaking even in the bank. They have a bank balance of 2,240, which is very respectable. So that's the theory.